are starting to go up here. People are starting to panic a little bit. Do you see it?
You're seeing it every day. And I think it was inevitable that time was going to come when interest rates started going up a little bit. So we're seeing it now just based on unemployment went from 7.9 down to 7.7. So that's really good for the economy. The Dow Jones is pretty much, I think, the highest it's ever been right now.
Yeah.
So all those things kind of combining with just higher consumer confidence, in essence, is going to bring up interest rates because the Fed does not want interest rates low. It's not good for our economy in general. So you're going to see it's just a matter of time before the Fed starts raising rates. I mean, we know they're going to be low for probably the rest of the year and into next year. But eventually you're going to see him get into the 5s and 6s again.
Yeah. Well, Roger Morris and Tim Lenahan are both here. Guys, I wanted to get some of your takes because I know you are in the trenches with people who are maybe buying houses and have lots of questions as far as what goes into a mortgage. Tim, I see you nodding your head over there. What are some of the big questions that you see?
How much can I afford? That's the big thing is how much of my monthly check can I afford? That's what people really, really want to know.
Perfect. So, and obviously we get that question a lot when we meet with new buyers, whether it's a first-time home buyer or a move-up buyer, but it's all kind of a formula these days, a lot different than it was in 2003, 2005, where anybody could pretty much qualify for anything they wanted. So now we're back to the fundamentals of lending where it's all an equation of three things. One is always going to be credit. Number two is going to be income, employment and income, and how much money they make, and then how much they want to use as a down payment. So a good number to use is say, okay, if you make $5,000 a month gross income, okay, 45% of that amount can go towards debt. That leaves about $2,250 as far as a total debt payment. And then you subtract what your current payments are going to be for stuff that comes up on a credit report, like minimum payments on a car, student loan, credit card, stuff like that. And whatever is left over is how much of a payment somebody could qualify for. And that's always going to be that balance of, okay, I can qualify for this payment, but I'm comfortable at this payment. So it's a balance between the two. And there's still times that people can qualify for more than they're actually comfortable with.
Nice.
Yeah, and then the balance of down payment and everything else.
I wanted to know, since in our market right now, it's really common to see multiple offers, and there's a couple challenges with that. The biggest one is obviously if they have a loan, it has to appraise for whatever they're willing to pay. And a lot of time the buyer is willing to go substantially over the list price. I always tell them, it has to appraise for this, and if it doesn't, the deal could go south. So I just wondered if you're seeing appraisals come in low, and in what markets are they? When we talk about inner city, is it different? I just had an appraisal come in lower in Renton, and we switched lenders, actually to Cobalt. They've rescued us, and the appraisals came in completely different. So I wondered what you were seeing and if the appraisals were issues.
Yeah, I think there's two ways to look at that. I think, one, I personally have not seen appraisals come in low yet, but I really think that's just a matter of time. I think if you're obviously starting to see them on your end, once that starts happening, the buyer and the seller have a couple different options. I mean, the buyer can either move forward with the process and bring money in, because the lender is just going to lend a percentage of that appraisal, and the buyer is going to have to bring the difference in to close. Or, which is kind of a gray area, is ordering a new appraisal. Okay, and I think that's kind of still a subjective thing where appraisers are going to go in, and most of the time they find ways to justify the contract price with comps. Okay, so it's kind of sketchy if one appraiser can look at this and say, okay, we have comps to justify that purchase price, and one appraiser doesn't. That's kind of a gray area, but at the same time, appraiser gets paid their fee regardless if they come in at the contract amount. And so if that's the case, a lot of appraisers are going to weigh on the side of caution as opposed to being aggressive. Because you can't get in trouble if you're conservative. You can get in trouble as an appraiser if you're escalating the amount and trying to justify the price of your comps. So that's probably what you run into sometimes. And that's the challenge with that. It's not lender specific a lot of times, is we can't choose our appraisers. It's kind of in this big pool. So, yeah. Sometimes it's just luck of the draw that you got kind of maybe one that was pretty conservative.
It's kind of funny, though, to think that you had one lender and the appraiser appraised something, and then you went to another lender and it appraised higher, and now it's all honky-dory, and most likely that loan is still going to be bought by Fannie Mae or Freddie Mac when it's all said or done. And so really it's the exact same process. It's just one lender got a different pick of a different appraiser, which is why part of the system is so screwy because of all these different regulatory walls they've put in between people. And it's literally like, you know, when you're in, you know, first grade or elementary school and you take the little fishing rod and you throw it over and it's got the clothespin on it and you get a little prize and you always wonder if you got the stickers or the whatever else they may be giving away. It's kind of like that with appraisers. You're either going to get a real good one or you're going to get you're going to get the crappy prize, and then the next thing you know, you're over back at the cakewalk table hoping you end up with a chair.
Yes, Roger, it's becoming more of a challenge these days, and I'm sure it'll become more of a challenge as we move forward.
Where do you see interest rates going over the next year or 2 years?
Yeah, I think we're on a trend that they're going to be going higher.
Yep.
I mean, we've known that for a while, and it's all based on the fundamentals of the economy. When you see, like I said before, the Dow at the highest it's ever been, unemployment going down, the Fed does not want interest rates low, the economy can't afford to have interest rates low, so it's just a matter of time before they start. I mean, we've seen them slowly go up. I mean, they've gone up a half a point just in interest rates since December. You know, when the fiscal cliff stuff got resolved and the election was over and just the economy, just people's confidence is just higher in general, and then home prices going up. All these things makes it hard for the Fed to keep rates low for too long. We know they're going to be relatively low for, you know, the next year or two, which relatively low could be 4.5 as opposed to 3.5. Yeah. But it's just a matter of time before they get back to 5, 6, 7% again.
Well, and people who own houses may finally, after 10 years, have their loan officer stop calling and saying, rates have hit all-time lows. It's time to refinance again. They're going to get a break.
No! That sounds horrible.
So I work with a fair number of first-time buyers, and I think the biggest challenge, lots of times they come with a lender already selected. If they don't and they ask me for suggestions, how do they approach a lender so that they're comparing apples to apples instead of apples and oranges to know what their costs are going to be to close? Is there any key things that they should articulate to a lender when they're talking to them? Because there's loan origination fees and there's points, and sometimes they say, you know, with 1 point down, and they're like, looking starry-eyed, what in the heck does that mean? So is there a way, so when they talk to a lender, they kind of get the strict same information comparing them?
That's a great question. It's a very hard one to answer because people shop for mortgages the wrong way, especially if they're shopping for mortgages based on rate before they even have a property. Okay, so people need to understand, especially first-time home buyers, you can't lock in an interest rate and nothing is guaranteed until you actually find a home, write an offer, and you have a contract. Okay, so if somebody comes to me or any other lender and says, hey, I'm shopping for a lender and I'm looking for the best rate and fees here for a home I'm going to buy possibly in 6 months. I'm like, all right, well, what do you want to hear? Here's 2% with no points and no closing costs. Like, oh my God, Ryan's the best ever, and I'm committing to working with him. I'm like, all right, great, that was pretty easy, because there's nothing that ties a lender to that. So shopping for rate and fee at the beginning it's the wrong way to go because they go down the wrong path.
The other thing on that point is they end up choosing the person with the lowest rate and lowest fees, which almost every time is going to be the one person who's bait and switching them. Because that's how they're able to quote the lowest fees and the lowest rate, because they're like, well, this guy they can't lock now. So it's almost the opposite. When you find that person with the lowest fees and lowest rates at the very beginning, they're probably going to be the least honest of the entire group.
Right.
Yeah, and everybody on the lending side, we know this, and a good lender is kind of transparent about that. But the consumer doesn't get it. I dealt with this the other day. He was all about rate and fee. And I said, it doesn't matter right now. He said, but this other guy's quoting less than you. It doesn't matter at the beginning. So I think the number one advice I give to any buyer in this market when they choose a lender is try to choose a lender that's local, that's reputable, that's professional, dependable, proactive in their communication, and is going to educate you through the process. Okay, because if you guys do listings, I assume. What do you what do you do with an offer when you have 10 offers, when it comes from an out-of-state lender, a lender you've never heard of, you call about that pre-approval and they don't have a lot of experience or they don't get back to you in a timely fashion? What do you do with those offers if they're all kind of the same as the other offers?
Yeah, and you put it towards the bottom of the pile. I mean, I hate to say like you're not just throwing it away, but it really makes you. You're concerned.
It.
Yeah, I mean, yeah, you shred it.
Yeah.
Yeah. Now it's a big concern because the last thing you want to have happen is that the deal fall through for your sellers, and you're left having to go back on the market, which you're not going to get the same offer that you did the first time around. So, like you said, working with a reputable, confident agent that's local that can get things done on time, because I hate to throw the big guys under the bus, but those guys just are pushing time limits for when the local guys can do it in 30 days and the big guys can do it in 45, 60 days. It's just not competitive.
It's hard enough to get properties under contract right now, let alone take that risk that you finally make 6 offers, and then on that 7th offer you get one under contract with a 30-day close, and then the lender you choose doesn't close on the loan. That's a tough proposition for when you're talking about hundreds of thousands of dollars to save a couple dollars. It's a tough bet. So you want local professional and somebody who you can trust, not just based on rate, especially at the beginning.